Today on Homestead Road Weekly News, mortgage rates are hitting their lowest point in years. But affordability remains one of the biggest challenges in the modern real estate era. Minnesota sellers are pulling homes off the market at the fastest rate we've seen in years. Childcare costs are now directly shaping our housing patterns. Wisconsin is seeing luxury real estate surges while middle-class buyers pull back. And Tampa Bay, not to be forgotten, their job boom is creating one of the hottest housing markets in the Southeast. I'm Devin Walton, and we're unpacking the stories behind the headlines with insights to help you buy, sell, invest, or simply understand what's coming next in real estate. So let's get started. Our top story this week is all about mortgage rates because for the first time in what feels like ages, buyers are finally getting a little bit of relief. The average 30-year fixed mortgage rate has dropped to around 6.22%, which may not sound spectacular, but here's the thing. This is near the lowest point of the entire year. Now that is a big deal. Think back to just a few months ago. Rates were on the rise. Buyers were panicking. The market was slowing down and many people were simply priced out of the market. Earlier in 2025, we saw rates cross 7% again, creating a wave of hesitation across the country. But now we're seeing a shift, and here's why. First, the Federal Reserve cut interest rates to their lowest level in 3 years. This tells the markets that inflation is cooling and financial conditions may continue to ease. Secondly, Treasury yields have been falling and mortgage rates follow those very closely. Treasury yields are a reflection of investor confidence, long-term risk, and inflation expectations. So when yields decline, mortgage rates usually follow. Thirdly, markets expect continued rate cuts. Into early 2026, we're expecting that there may be some more incentives to drive that rate even lower. Markets behave based on expectations, not just current numbers, so that's why rates are drifting downward, even after small fluctuations. Now, does this mean we're heading back to 3% rates? No, it doesn't, and economists are being very clear about that. But it does mean that we are entering 2026 and we're starting from a much more favorable position than we had for most of 24 and 25. What does it mean for buyers? Well, monthly payments drop noticeably when rates fall even 0.5%. More buyers can qualify. More buyers enter into the marketplace and re-enter the marketplace after months of maybe waiting or sitting on the fence. So what does it mean for sellers? More buyer activity, faster offers, better showings, stronger negotiation power in some markets. But there is a twist. Even though rates are easing, a new report shows over 75% of homes in America remain unaffordable still today for your typical household. So we're still in a market defined by high prices and limited supply, even with better mortgage rates. This creates a really interesting tension heading into early 2026. We all know that's the spring market when we see a lot of activity. More buyers are willing to shop again, but they're still constrained by price and income limitations. So if you're thinking about selling while rates are finally giving buyers a chance to breathe, Homestead Road can guide you through that process from start to finish. Get your free no obligation offer today at homesteadroad.com. Now let's take a closer look right here in Minnesota. And what we're seeing here is a very revealing trend about seller confidence. Across the United States, delistings, meaning sellers removing their homes from the market, have jumped over 45%, and Minnesota is firmly a part of that pattern. So here's what's happening. Many homeowners still believe their home should sell for the same prices they saw during 2021 and 2022, kind of a mini boom in the housing market. But buyers simply can't stretch the same anymore. High home prices plus tight budgets, plus cautious sentiment equals an affordability wall. So instead of adjusting their price downward, many Minnesota home sellers are choosing to simply withdraw their product and their listing off the market altogether. So this leads to several real estate consequences. First, inventory looks tighter than it truly is. Homes aren't disappearing, they're not selling, they're just waiting in the background for what they feel is a better moment. Number two, market time increases for active listings. Buyers pick and choose a lot more carefully when inventory starts to stagnate. And three, pricing tension grows heading into 2026. If sellers resist price cuts and buyers resist overpaying, the market enters a kind of slow motion tug of war. Four, winter exaggerates this trend. Right here in Minnesota, our winters already reduce buyer activity. Everybody's staying inside, staying warm, and staying off the road. So delistings on top create even more seasonal slowdown. This is one of the most important signals to watch. Sellers are not adjusting, they're retreating. And that could lead to a very interesting spring market next year. So what I've got for you to think about is this. If you want weekly updates about Minnesota's shifting market, hit like and subscribe. Homestead Road News is here every week to break down what's really happening behind the headlines. This next Minnesota story is one that often goes unnoticed, but it plays a huge role in real estate. Childcare availability has slightly improved, meaning there are more openings. But here's a real problem. Affordability, just like in the housing world, it has not improved at all. Many families are paying more for childcare than they are for their mortgage or for their rent. And that reality has major ripple effects on the housing market. Families delay moving to larger homes when childcare costs exceed a second mortgage payment. Upgrading becomes unrealistic. Parents stay in the rental properties much longer. This slows first-time homebuyer activity, which affects the entire housing ladder. Dual income households become single income households. Less income, smaller buying power, smaller market movement, much slower market all in all. Suburban versus urban housing shifts accelerate. Families may prioritize childcare availability over commute times, reshaping where demand rises or falls. All of this means that Minnesota's housing market is being influenced not just by rates and prices, but by the economic pressures placed on families and the pressures that those families face behind closed doors that we don't talk about or we don't see every day. Childcare costs are becoming a dominant force in housing decisions, and this dynamic is likely to play an even bigger role in 2026. If you're planning a move in Minnesota and want some guidance in a market shaped by affordability, then Homestead Road can help you. We help you move along easily, confidently. Visit us at homesteadroad.com or hsrrealestate.com as well. All right, let's shift over to Wisconsin, where we're seeing a very different story. A story of resilience in the luxury real estate market sector. A brand new $1.7 million luxury condo overlooking luxurious Lambeau Field just hit the market. Now, this isn't your average condo listing. It features a private elevator, premium finishes, stadium views, and sits in one of the most iconic sports locations in America. Now, why does this matter for the broader market? Because it highlights a major disconnect that has been building for years. The mainstream housing market is struggling with affordability, but the luxury market in certain areas of the country remains strong, Wisconsin being one of them, especially in niche, high-demand areas. Wisconsin's luxury segment continues to attract investors, out-of-state buyers, retirees moving from higher-priced states, and fans who want lifestyle-based properties. This tells us something important. Real estate is not a single market. It's many markets operating side by side, each responding differently to economic conditions. And in Wisconsin, the luxury tier is sending a loud message. Demand is alive and well at the top, even when it softens elsewhere. So, for all of your complete information, If you want deep state-by-state insights every week, make sure you like this video, subscribe. We'll bring you the data, the context, and the stories that you won't hear anywhere else. Finally, let's head down to Tampa Bay, Florida, where the job market is rewriting the housing narrative. Tampa Bay has posted nearly 7% growth in job listings over the past 5 years, a performance that outshines many much larger cities across the entire U.S. Now, this growth is being powered by healthcare, hospitality, tourism, business support roles, remote-friendly employers expanding their footprint. Job growth is one of the strongest predictions of housing demand. When jobs surge, housing follows, and Tampa Bay is proving that relationship again in 2025. People are moving in, rentals are filling up, starter homes remain competitive, and higher income buyers continue to relocate from northern states. Even after affordability concerns, Tampa Bay is managing to remain resilient because people go there and because the jobs are there and people buy homes where job security is high. Looking ahead to 2026, Tampa Bay could be one of the strongest markets in the entire southeast region, especially if job growth stays steady. If you're thinking about selling in Minnesota, Wisconsin, Florida, or anywhere in between, Homestead Road makes the process simple, fast, and stress-free. Visit homesteadroad.com to get your no-obligation, free offer today. Well, that wraps up this extended edition of Homestead Road Weekly News. Thanks for joining me as we explored mortgage rate shifts, Minnesota market pressure, the role of childcare in housing, Wisconsin's luxury momentum, and Tampa Bay's job-driven boom. I'm Devin Walton. I'll see you next week with even more insights to help you stay ahead in real estate.